Meet Joe Investor. He's always on the wrong side of the market. Last year, Joe Investor was shorting stocks when he should have been long. And the year before that, he was parked in cash when he should have been invested in bonds. Are you always on the wrong side of the market just like Joe? The Profit Strategy newsletter at etfguide.com will help you to succeed. Join today and get a $100 gift by using promo code JOE100. Go to etfguide.com to get started and promise yourself to never ever be on the wrong side of the market.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Emerging markets are burning. The stock market's mood is getting quite bouncy. This is the Index Investing Show. We're going to be talking about all of that and more. My program guest is Andy McOrmond. He's with WallachBeth. They are a New York-based institutional trading and execution firm. How can you make better stock trades? How can you make better ETF trades, regardless of whether you're a long-term investor or short-term trader? Good order execution is critical. So we're going to talk with Andy McOrmond a little bit later on today's show. You will not want to miss that. We're also here live talking about any stocks, mutual funds, ETFs. We're talking about financial markets. And if you'd like to join us to talk about a specific ticker symbol or investment theme, I'm game. 877-711-5611 is the number. Ron at indexshow.com is the email address. My Twitter handle, at Index Show. You can follow us 24/7. I'm very active on Twitter. And let's get right to the stock market, which this past week had a pretty rough week. Actually, thus far in 2014, it's been a pretty rough year for stocks, but it's still early in the game. And one of the indicators we've told you about before, and we're tracking it very closely, is the January barometer, which basically says, so goes January, well, so goes the rest of the year. So if January's bad, well, then the rest of the year is likely to be bad too. Now, not always perfect, the January barometer, but pretty accurate. Over the past couple of decades, it has an accuracy ratio higher than 87%. So we're going to keep you following this particular barometer because it could very well tell us what 2014 will turn out to be like. One of the things that a lot of people are blaming this particular market on is the sell-off in stocks is valuations. Oh, valuations are too high, or the stock market is sky high. And I've told you before, and I'll say it again, that the market does not have a trigger in its brain that suddenly says, well, stocks are overvalued, so I'm selling off. I mean, that's not the way the stock market works. Likewise, when the stock market is undervalued, it doesn't all of a sudden rally because in its brain it says, well, stocks are undervalued. It's time to rally. That's not how the stock market works. It really is a game of psychology. And we talked about it on last week's program. If you missed it, we do have our program archived, as we do all shows, on our podcast at iTunes, also at Stitcher, and as well as our YouTube account, where you can listen to the program. But we talked about market sentiment. In other words, the market's mood. What is the mood for stocks? Well, over the past 10 years, it's been quite positive. In fact, 9 out of the past 10 years, stocks have been up. 4 out of the past 5 years, stocks have been up. So we're overdue, definitely, for some sort of correction. I mean, the market can't go up forever. And we have an environment where the market sentiment has been overly bullish, quite frankly. Now, that doesn't mean that all stocks will go down. And we're going to talk about one particular sector that I have highlighted to our subscribers at ETF Guide that is just sizzling. And it is a stock market a particular stock market sector. And this particular sector has been the right place to be. Now, it was the wrong place to be in 2013, but I'm going to tell you about one of the best performing sectors thus far in 2014, and that is holding up quite well. One of the other things I want to mention about market sentiment is something called excessive leverage, which is a telltale sign of overconfidence. And this always poses a grave danger to not just stocks, but all markets. Now, over the past 15 years, we've seen this pattern of boom and bust consistently repeat itself. We saw it with the 2000 to 2002 dot-com crash. We saw it with the 2007 to 2009 housing crash, and then the subsequent 2008 to 2009 financial crisis, where excessive leverage played a key role in kind of telling us ahead of time that there was way too much overconfidence in the market. Now, this time around, we're seeing something similar. Record high margin debt, and we put this in our just published February newsletter. We've been talking about record high margin debt over the past several months, but this always spells trouble ahead. Almost every major market top and subsequent correction or crash is associated with excessive leverage or excessive borrowing, excessive risk-taking. And right now, we see that with the New York Stock Exchange margin debt rising for 5 consecutive months. It's at a record high right now at $423 billion. That's for November. I don't think we've gotten December's figures just yet, but I'm sure we will probably match or top that $423 billion record for margin debt. So what's the translation? Never before in history has a ferocious borrowing binge by investors or speculators with margin debt ever had a happy ending. Will this time be different? 877-711-5611 is the number. We're here. You're listening to the Index Investing Show. If you want to talk about a particular stock, mutual fund, ETF. So far, year to date, the S&P 500, SPY is the ETF that tracks that, down 3.1%. Ticker symbol VWO, which tracks emerging market stocks, down 7.7%. And the underperformance of emerging market stocks continues. And I have told you on this program time and time again that especially Chinese stocks, there's only two methods, I believe, for the prudent investor to approach Chinese stocks at this particular moment. And that's number one, to aggressively avoid them, or number two, aggressively short them. That's your roadmap right now for Chinese stocks. And anyone that tells you, well, Chinese stocks are a deal, they're a bargain. Anybody that tells you that, and I've got a couple of tweets I want to read from a CMT, a financial professional who's touting Chinese stocks as a buy. Totally ignorant advice. I want to talk about that a little bit later, but being long Chinese stocks, and I've told you this, is not the right place to be, and it's going to turn out to be, at least by all indications thus far. This started in early December, by the way. This sell-off, this is not something new to 2014. It will not be year of the horse. It could very well be year of the bear for Chinese stocks. That's the way it's been so far, and I see this as a major opportunity for bears to make some big-time money. In fact, what's happening in Chinese stocks right now, the bearish sort of action that we're seeing could very well equal or exceed what happened with gold last year. So you bears that made money on gold, shorting gold last year, well, you could see that same sort of opportunity right now for this year in Chinese stocks. Ticker symbol FXP, which aims for double daily opposite performance to Chinese stocks, ahead 15% year to date. YANG, which does the same thing, but triple daily leverage or opposite performance to Chinese stocks, ahead by 23%. And we've got a timestamp trade. FXP at ETF Guide, our weekly picks. We've been in FXP since early December. It's already ahead almost 30%. That's a timestamp trade, by the way. This is the Index Investing Show. I'm Ron DeLegge. Join us. What particular stocks, mutual funds, or ETFs are bothering you? We're here, you're there, and I'll be right back.
The Index Investing Show with Ron DeLegge.
All right, 877-711-5611. We're here. If you want to talk about any stocks, mutual funds, ETFs, you want to talk about the stock market, we're down year to date on the S&P 500 around 3.1%. Does that worry you? Are you prepared? Do you have cash in your portfolio? Cash has certainly been a hated asset over the past several years with stock prices rising. And all of these people that told you to be fully invested were basically wrong. In fact, I've been telling you quite opposite. In fact, cash is a very important asset class, and I believe all investors should have some cash in their portfolio. Now, the exact precise amount of cash will vary depending on your specific circumstances, but the point here is having a little bit of cash in your portfolio will do two things. Number one, it will cushion your investments when we have sharp corrections or market crashes, and we will have them in the future. So that's number one, it'll cushion you. Number two, having cash in your portfolio will afford you the, I don't want to say convenience, but it will afford you the opportunity to buy assets at lower prices, assets on sale. Now think about it. If you're fully invested and you have no cash, well, you don't have that luxury of buying assets on the cheap when everyone else is selling because you're fully invested. The only way you can raise cash is by selling your fully invested assets at lower prices. So this is why cash I think will become an increasingly more important asset class. And take a look at your investment portfolio. If you're fully invested, I think you're making a big mistake. It's always a good idea to have some cash in your portfolio. Now, a couple of announcements I'd like to make. Direction Shares has just launched a couple of new ETFs that I need to make you aware of. They launched the Direction ZAX MLP. That stands for Master Limited Partnership High Income Shares. Now, the ticker symbol on this particular ETF is ZMLP. It's linked to the ZAX MLP index, and that is comprised of 25 different Master Limited Partnerships, MLPs, listed on North American stock exchanges. And this particular area is something that those of you looking for high income might want to check out. ZMLP is the ticker symbol on that one. Now, Direction also launched a pair of leveraged and inverse performing ETFs linked to European stocks, ticker symbol EURL. Again, that's EURL, aims for triple daily performance to European stocks. And then EURZ aims for triple daily opposite performance or bearish performance to European stocks. So that pair of ETFs for those of you that want to play Europe and what's happening over there. Now, I want to talk a little bit more about one of the best performing sectors of 2014, which interestingly was the same industry sector that was one of the worst in 2013. So isn't it incredible? We've been talking about market moods and market sentiment and market psychology and how that plays a key role in shaping prices in the stock market and in financial markets. And we had what I call at the end of 2013 overly bearish sentiment. We had an extreme, and that extreme was present in gold and also gold mining stocks. Gold mining stocks were down last year about 54%. And the year before that, they were down. And the year before that, they were down. In fact, over the past 3 years, gold miners have been a horrible, horrible place to invest. Down almost 80% over the past 2 or 3 years, actually 3 years, from 2011 to 2013. Well, every asset class, every stock, every sector eventually has a key turning point. And we've reached that with gold miners. We told subscribers at etfguide.com this would be the place to go long. And that was in our weekly pick on December 26th, right before all of that year-end tax loss selling exhausted itself. And we said it was time to go long gold miners. Well, have we been right? We have. Gold mining stocks, one of the best performing sectors year to date. GDX, which tracks large cap gold mining stocks, ahead by 12% so far year to date. Gold itself, another one that we went long actually December 20th, we did a trade in our January newsletter buying gold options, which, by the way, have already increased more than 50% on GLD. And that's been a great trade. That was in our January ETF Profit Strategy newsletter. So this has been a great performing sector year to date. And not all equity sectors are negative like the S&P 500, which is down just a little over 3%. You've got healthcare stocks, which have a small gain year to date of around 0.5%. XLV, that's been a leading sector. Also, another leading sector has been biotechs, XBI, which have a small gain. And then utility stocks, ticker symbol XLU, are flat, and that's a defensive sector. I would begin to get really, really concerned about a more severe correction when we begin to see some of these industry sectors that were leading begin to start to follow the rest of the market. So some of these areas like healthcare stocks, which have been leading, we start to see healthcare stocks begin to really get pounded, then I would really begin to get concerned and worried that something else deeper is happening. And another area that has been getting pounded worse than the S&P is not much of a surprise here. XLY, which is the consumer discretionary sector, down 5%. Now, this was among the top performing sectors in 2013. This is, I guess, another lesson in why choosing last year's winners doesn't work necessarily. Last year's hot shots are often this year's turkeys, and that applies not just to top performing fund managers, it also applies to top performing stocks and top performing funds. And in this case, that is so far playing out with the consumer discretionary sector, which was last year's hot shot, but so far it's been a turkey so far this year. 877-711-5611 is the number. We're here. We're live. If for any reason you ever miss our regular weekly broadcast, you could pick up our free podcast. It's available at iTunes. Just search under the Index Investing Show. We have just come out with my monthly newsletter at etfguide.com. It's called the ETF Profit Strategy Newsletter, and the February edition is out. And my colleague Chad Carnes covers the technicals. We have the top performing, some of the top performing sectors, highest yielding sectors. We also cover global yields. Our global equity map is pretty popular, which basically shows the ETFs covering the major areas around the globe by region, and we've got a nice map of that. And so far the map shows that just 2 areas are in positive territory and the rest are in negative territory. So which are those? Well, you can get that at etfguide.com. Also, our mega investment theme report is pretty popular. We highlight 10 mega investment themes for not just the year, but each month, and we update them. We move them up and down accordingly. Topping our mega investment theme report so far is emerging markets. And we have talked consistently about the lagging performance of emerging market countries, the equity performance that has lagged developed markets, and we're seeing that continue in 2014. And we're seeing some big bearish moves, not just in Chinese stocks, but Latin American stocks and Brazilian stocks, which are getting pounded also. Coming up next, How can you make better trades? My program guest, Andy McOrmond, will be joining us. This is the Index Investing Show. Go nowhere.
The Index Investing Show with DeLegge.
Have you met Jane Investor? She wants her investments to grow, but she's too busy to bother. In fact, Jane Investor is so busy she didn't realize owning real estate investments in the wrong brokerage account exposed her to unnecessary taxes. She also forgot to roll over her 401k plan because, well, she was too busy. The Profit Strategy newsletter at etfguide.com helps busy people like Jane Investor to stay on top of their investment portfolios. We tell you what to buy, what to sell, and when to do it. It's okay to be busy, but it's not okay to be sloppy with your investments. The Profit Strategy newsletter at etfguide.com will save you time and help you to succeed. Join today and get a $50 bonus by using promo code JANE50. Our monthly newsletter, our weekly picks, and our technical forecast will keep you ahead of the pack. Go to etfguide.com to get started and promise yourself to never, ever be too busy to be properly invested.
How can you make better stock trades and better ETF trades, regardless of whether you're a long-term investor or a short-term trader? Good order execution is an absolute must. And here to talk with us about that is Andy McOrmond. He's a managing director at WallachBeth, which is based in New York City. They do institutional trading and execution. Andy, welcome to the Index Investing Show. Great to have you with us.
Thank you so much. Great to be on.
When it comes to buying or selling an ETF or a stock, people always have the question, what's the best way to execute that buy or sell order? Is it with a market order at current prices, or is it with a limit order at a predetermined price? What's your philosophy on market orders versus limit orders?
That's a great way to start this off. And I'll say that the first distinction that I would like everyone to make, and this goes for a retail level or an institutional level, is understanding that although an ETF is listed just like a stock, and it's going to clear just like a stock, whether you're trading it on E-Trade or Schwab or whatever your venue is for trading it, it operationally is also a stock. However, it trades far different. Now, the smaller orders, some of the same rules apply, but what we're going to discuss today is just a way to understand that the real value of the ETF is its underlying asset class. And we'll go over that in the interview, but for the purpose of this question, just like a stock, you want to be careful with a market order. So, and especially in an ETF, because ETF tends to be thinner, and they tend to trade around the asset value of the product underneath the ETF versus the actual ticket itself. So a limit order will protect you. Now, we understand that in a retail side, you want to get in this trade and get out and get the order done. So I'm going to introduce a term, if you're not already familiar with, called a marketable limit order. And what that means is look at the prices on your screen. If you're comfortable with that, then just put a buy order in, let's say 2 to 3 cents above your limit, if you're above the limit on the screen if you're buying, and a sell order 2 to 3 cents below the bid. You are protected by Reg NMS, so you won't trade at a worse price, but what you will prevent is the chance that a market order goes to a thin product, or at the time you send your order, another larger order clears out the market, and therefore you have a trade that could be down, 1, 2, 3% just on a mini odd lot. We've seen it often. So the advice for the question, again, is marketable limit order or a limit order, but certainly not a market order.
Andy McOrmond of WallachBeth joining us. Now, some ETFs, as you alluded to there, have very thin trading volume. So is there a minimum in terms of trading volume that investors should keep as a benchmark?
I don't usually stay with one because what happens is you can have an ETF around an index benchmark that is liquid, but is just a new idea. For example, we all know the S&P 500 is ranked market cap weighted. Well, now there's ETFs that are dividend weighted. There's ETFs that are fundamentally weighted. So you as an investor may say, hey, I like that. I think that this idea is going to return, some alpha or a little bit better than the standard market cap. However, the ETF is not as popular, so the average daily volume is lower. So the two things to look at are, is the underlying asset class liquid, and what does the spread look like? If the spread is not that wide, meaning the difference between the bid and the offer, then the ETF again, should be fine to trade for the size that a retail person is doing. And just keep in mind, if the underlying asset class is liquid, then you should be fine in the product. The average daily volume or the daily trading volume does not mean, if it's thin, that an ETF is going to close down. It just means that there's not as many pros and individual investors trading the product.
If you're just joining us, you're listening to the Index Investing Show. Pleased to be talking with Andy McOrmond. He's with WallachBeth, based in New York City. They do institutional trading and execution. Now, I've heard the argument, Andy, that stop-loss orders are a bad idea for an ETF investor because they can get kicked out of a position if the fund suddenly hits that price and then suddenly bounces back and they lose that upside opportunity. So what's your take about stop-loss orders? Do they do more harm than help?
Well, here's the thing I would say about stop-loss orders. It really is up to the individual investor and what his goals of the investment are. It's hard to make a blanket statement that you should use them or not. I would start out by saying, not to have a cliche, but it's always seemed like kind of a Murphy's Law thing. You put, like you mentioned, you put your stop-loss order out there. There's a bad day. It hits the stop at your level, which happens to be the low for the year, and then all of a sudden the stock rallies. I mean, we have seen that, but I do think, like I said, that's kind of a Murphy's Law thing. You got to look at it from the other side of the coin. A lot of listeners, I'm sure, to this program are not full-time traders, so they have their levels, right? They might set them for the day, maybe they set them for the week, or maybe they put a GTC order in for a month. Well, you don't want to be on vacation when an index or a market collapse, or let's say the market goes the other way and you're short, and you miss your move because you weren't prepared. So it's hard to tell somebody that when the market takes an 8% correction, and you would have been out at 1% if you had a stop-loss order, that you shouldn't have a stop-loss order, right? You just need to know what they are, and I would also add that you can use a stop limit order. So therefore, you don't have that kind of order where it triggers it and then goes to the next exchange and maybe trades down another 10, 15 cents. But if your goal is, I do not want to lose more than 2% on this investment, and you can't be in front of your trading screen every day, then there is a place for stop-loss orders in your investment, ETF or equity, that is.
Now, all securities that trade on an exchange, including stocks, will have a bid-ask spread, and the larger that spread, the larger the trading cost is to the investor. Now, for ETF investors, how can they limit the financial impact or cost of bid-ask spreads?
Well, this is where you have a little difference, and I always like to tell the truth, and I don't pull any punches when it comes to ETF investing and trading. So I will say that institutional investors have a slight advantage when dealing with a wider spread ETF. And that involves the creation redemption mechanism behind an ETF, and that larger blocks of ETFs can be hedged easier by the market makers that make the markets and the products. So, but for this call and for this, conversation, for a retail investor worried about spreads, they are relevant. And you're absolutely right, and it's a great point to point out that a large bid-ask spread does affect your trading cost. If you're trading an ETF that's 20 cents wide and there's a similar ETF that is a penny wide, well, then it's important that if the product is correlated enough and doesn't differ from your strategy, then as a retail investor, you will have lower trading costs by trading the ETF with the tighter spread, and it will limit the financial impact. ETFs do mature every day, though, and what I mean by that is an ETF idea garners popularity as the begins to get more volume. The spreads tighten quicker simply for the competition aspect that's going on in trading. So an ETF that you like and might be too wide for you to trade today as a retail investor, make sure you get in a correlated investment so you have your exposure to the asset class or the index, and just keep checking back because you might be surprised that the spreads tighten on that ETF as time goes on.
That's a great point. And also it depends, too, how long you plan on holding that ETF. I mean, that could be a factor also.
Absolutely true. I'm glad you pointed that out. If you're going to hold an ETF, for a year or 2 years, and especially since the show, is about indexing, and most indexing investors tend to be more long-term and less tactical, right? So if you're tactical and you're crossing that 10-cent wide spread, even if you're trading I would say once a month, that's going to affect you. But if you are a long-term holder, I would say get your marketable limit order in there. A spread that's 10, 20 cents wide over the long term is not really going to hurt you. Of course, always be wary, though, because there is ETFs out there with dollar spreads. So always make sure you check the first two digits when you're putting that trade in.
Market liquidity, an often misunderstood term. Explain quickly what it means and how it applies to the ETF investor.
Absolutely. We kind of went over it real quick on those other points, and I'll just point it out real quick with a real simple example. Market liquidity in an ETF term is how liquid are the assets that make up the ETF trading. And to put it real simple, we all know how liquid the S&P 500 are. The 500 stocks that make up that index trade extremely liquid. The ETF S&P SPY also trades extremely liquid. If I came out with an ETF that ranked the S&P 500 in alphabetical order, that wouldn't be a great investment idea, correct? But the underlying asset class would be the S&P 500. So technically, the ETF could be very liquid if it needed to be.
Great explanation and great ideas. Thank you so much for sharing your knowledge with us. You just heard from Andy McOrmond of WallachBeth. This is the Index Investing Show. I'm Ron DeLegge, and I'll be right back after this short break.
The Index Investing Show with Ron DeLegge.
Wow, that was a great interview there with Andy McOrmond. We talked about how you can make better stock trades, better ETF trades. And man, if that segment didn't help you, well, then you weren't paying attention. And if you want to hear it again, you can listen to it via our podcast available at iTunes.com, or you can listen to it on Stitcher. We've got a Stitcher account, or you can listen to it on our YouTube account. 877-711-5611 is the number. You're listening to the Index Investing Show, and it's time for us to get into some of your tweets and emails. This is an email from Vance. I don't know where he's emailing from, but he's got a question about the VIX. Dear Ron, over the past 2 days, I bought 530 shares in ticker symbol UVXY as a portfolio insurance hedge. I have two questions. Are there any better ETFs for that purpose? And I'm up around 5%, and I'm wondering if I should consider selling to lock in my gains or keep the position to continue the insurance strategy. Again, this is from Vance. Vance, UVXY is more of a strategic trade versus portfolio insurance. Remember, UVXY uses 2x or 200% daily leverage to the VIX. So it's aiming to get magnified performance to the VIX. So if the VIX is up 2% in any given day, this is aiming for double that. So that's an extremely aggressive trade. It's not insurance. Now, the gains happen fast, but they can also pile up pretty quickly if you're wrong. So don't be stingy. If you make a gain, don't be afraid to take it and enjoy it. That's the purpose of these types of leveraged products, is they're short-term trading tools. But if you want insurance, that's a whole different subject. VIXY is something you might want to take a look at. It's an unleveraged play on rising stock market volatility, or VIX. So if VIX continues to rise, as it has here over the past week, VIXY will rise accordingly. So that would be more in line with my definition of portfolio insurance. Another choice would be ticker symbol SH, which aims for daily opposite performance to the S&P 500 without any leverage. Let's get into some of these tweets. Mark Newton, he's a financial professional and a certified market technician. He shouted out a tweet: emerging markets should be in the final stage of decline versus developed markets after having performed since October and spiking lower in December. Well, Mark Newton, you are completely wrong in my view. Emerging market bulls have been saying the same thing after a few years of relative underperformance to developed market stocks. Market prices right now are not saying that emerging markets are in the final stage of a decline. And the problem here is when you focus so exclusively on charts, when you ignore what's actually happening on the ground level, you're going to make some serious mistakes in judgment, and you're going to buy ETFs, you're going to buy stocks at the wrong price. And I think that's what's happening. Negative sentiment toward China, negative sentiment towards emerging markets is for sure picking up. There's no doubt about that. But what's happening at ground level trumps everything. And buying on the dips in this market is like stepping in front of a freight train. So if you're bullish on emerging market stocks, if you're bullish on China, the only thing that I can say to you is to be patient because lower prices are ahead. For the prudent investor, and I'll repeat this again because it's worth repeating. For the prudent investor, the only place to be with Chinese stocks is aggressively short or aggressively avoiding them. Those are your two choices for the prudent investor at this point. And we have actually strategically been aggressively short Chinese stocks since early December. And that trade, FXP, which aims for double daily opposite performance to Chinese stocks, has been a star performer. And I'll be happy to send you, anybody that wants to see that time-stamped report from December 6th that was sent to ETF Guide subscribers. It was a buy alert. I'll be happy to show it to you because everybody, when things really get heated up like they are, they begin to say, well, I told you so, and you should have done this, and you should have done that, but there's no track record of that ever happening. It's like these gurus, they come out of the woodworks, and they say, yeah, 100% of my recommendations have been making money. Well, is that really true? Well, it's not, because number one, they're not tracking anything that they say. There is no accountability. So, of course, they're going to be right all the time because there's no accountability. But when you timestamp it, well, it's got some accountability to it. That's what we do at etfguide.com, by the way. 70% of our weekly picks were winners last year. And so far in 2014, we're doing pretty good. We're in the midst, right in the thick of this great sell-off in emerging market stocks, Chinese stocks. Last year, we were right in the thick of it with the great gold crash. And we actually, that was our best trade last year, was shorting gold mining shares, gold mining ETFs. Our February 2014 trade, actually the exact date of that was February 14th. That particular trade up 525%. That was a trade that took, by the way, several months to blossom and to develop. But I think we're going to see that same sort of action in the Chinese market. We will keep you posted on it. How about Abby Joseph Cohen telling Barron's that the S&P 500 could hit 2,088 in 2014. In other words, up 16% from current levels. Let me just say this. Has there ever been a year when Abby Joseph Cohen has been negative about stocks? When besides never has Abby Joseph Cohen ever been bearish on stocks? She always says the same thing. She's a broken record. Let me say this, though. When Abby Joseph Cohen turns bearish on stocks, that'll be your buy signal. She is the ultimate contrarian indicator. So just beware. I can't even believe that she's still on Barron's roundtable. It's just incredible to me that they keep her. She should have been kicked off years ago. 877-711-5611. You're listening to the Index Investing Show. We're here. We're live. We also did, by the way, in my just published February ETF Profit Strategy newsletter at etfguide.com, our monthly income trade. We have an income mix portfolio. We launched this back in February of 2012 with the idea of generating high monthly income by selling covered calls. And this particular month, we do, well, like all months, we do it 1 month in advance. So we're in January. We just executed our February trade, and we generated $700 of monthly income. And actually, going back to when we first started our portfolio, the income mix portfolio, December of actually February of 2012, if we go back to that inception date, we've generated $19,297 in this particular portfolio of actual monthly income. So if you are interested in high income, over and beyond and above what you're getting from your dividends or from your interest income, well, selling covered calls is an outstanding strategy. And I've also got a link, by the way, if you want to learn more about how to sell covered calls, because we don't have time to discuss it on the show. The Options Industry Council offers some free and what I would say outstanding online courses on how the covered call system works. It's not as complicated as it may sound. It's actually a quite simple strategy, and it is something that in this type of environment of depressed low interest rates is quite effective. By the way, the 10-year yield on U.S. Treasuries has fallen 8.7% since the beginning of the year. It's now at 2.73%. So again, interest rates are still at depressed levels, and this is what you want to do if you're a high-income investor. A radical environment like we have requires a radical answer, and I think a high-income portfolio that's aggressive by selling calls is a great strategy if that's what your game is, high income. Well, that does it for another episode of the Index Investing Show. Thank you so much for joining us. We'll be here again, same time, same station next week. ETFguide.com, read my articles, and I'll see you next week.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.